First of all, do you understand what you are investing in? If you cannot explain what you are investing into somebody else, don't. Welcome to the Teacher Money Show, the podcast dedicated to helping teachers navigate your unique financial challenges and unlock your financial superpowers. I'm your host, Sean Morgan, a full-time teacher. That's right, I teach every day just like you, and personal financial coach. And I'm here to help every teacher, whether you're a seasoned teacher looking for fresh insights or a new educator navigating your first paycheck, to have a richer wallet, classroom, and life. The contents of this podcast are informational in nature and are not legal or tax advice, and neither I nor my guests are engaged in the provision of legal, tax, or any other advice. You should not act upon this information without first seeking appropriate advice from an accountant, financial planner, lawyer, or other professional. Okay, it's just me and you again here today, and we're going to be talking about investing. I want to dive deep into different facets of investing over the course of this season. So let's just dive in and get around to the basics of what it means to invest and ways that we can invest. Investing is putting your money to work for you. What that means is you are lending that money out to other people in various forms, and they're going to be paid back to you in forms of interest, dividends, growth in equity, and so forth. So however you are putting that money out there for other people to use, and then they're going to pay you back, that's investing. This is wildly important for meeting your goals. It's not just something we do because you have a bunch of money lying around. If you say need $1 million to retire and you are determined to save that much, and say you have $1,000 a month that you can set aside towards saving for $1 million for your retirement, it will take you just over 83 years to save that much. Ain't nobody got time for that, right? We're not going to work for 83 years. So we have to invest it. If you invest that same $1,000 and get an average 8% annual return on your investment, which is not unheard of for someone who just puts their money in the stock market. Once again, it's not an interest rate that you're receiving from the stock market, that's equity, but we'll just say it's an 8% return on your investment on average with the stock market. It would take just over 26 years. That's less than 1/3 the time it would take to achieve your $1 million goal if you are putting just that $1,000 a month towards your goal. So without investing, you cannot build up the money you need to retire. It's just not going to be possible. And these rules that we have about how much money you need to have saved for retirement only work if you have that money set aside in a place that's going to generate a return on investment. So it's really important that you are investing your money for retirement, so that way you aren't going to have to work until the day you die. I know we've all seen these substitute teachers who are working 10, 20. I've seen some that are probably 30 years past their prime teaching time, and they're there every day substituting because they weren't prepared for retirement. And I don't want you to have to do the same thing. So how do we choose the right investment? Well, let's talk generally. What are some things to consider when you are looking at an investment? First of all, do you understand what you are investing in? If you cannot explain what you are investing into somebody else, don't. Now, stocks are pretty simple, but if you don't really know what investing in stocks means, you might want to do some research first instead of just putting your money blindly into stocks. Now, putting money into stocks is pretty mainstream, but putting money into a specific stock, just because you know what stocks are in general, doesn't mean that putting money into a specific stock is a good investment, just because you can talk about stocks generally. If you're going to go with a specific stock, you need to be able to explain why you're choosing that specific stock. The answer should not be because my Uncle Jerry told me so. You need to understand the company. You need to understand why you think that stock is going to go up. You need to understand a lot of things before you're putting money into a specific single stock. There are ways to invest more broadly than that, and we'll talk about that. But the point is, if you don't know why or what you are investing in, you can't explain it. For example, I was putting money into crypto. And I could not really tell you why crypto was an investment. I was just putting money in because somebody told me to. And then I pulled my money out because I had a financial emergency and I figured I'd rather use that money than something else. And then like 2 weeks later, it dropped in value. And I was like, man, I'm a genius. I was not a genius. I was lucky. I was basically gambling because I had no idea what I was doing. If you understand crypto and you think you know why, certain coins are going up in value and you've tracked it over a long time and you figured it out, that could be an investment. But for most of us, just throwing money at it because it's a trend or people are talking about it is not the right thing to do. You need to understand it. The next thing to consider is risk versus reward. Generally, the more risky something is, meaning the more likely you are to lose money on it, the more rewarding it is, the more money you'll make if it works out. So there is a higher chance that you'll lose money, balanced by a higher chance that when you make money, it'll be a higher amount. Uh, but if you get too high of a potential reward, you're just so unlikely to get it that you might as well be going to Vegas and betting it all on black. So we don't want that. But if you have too low of a reward, meaning that there's hardly any reward at all, but it's not risky at all, you're putting money into a saving account, and that savings account is just not going to grow in any way that is meaningful, right? Uh, some big banks have a 0.01% savings account. That gives like I had like $1,000, balance, and I was getting like a penny annually, right? That's just not going to move the needle at all. So that's probably a little bit of an exaggeration, but the point is that you need to realize that you must have some risk to get the reward that you need, but too much, we're up to the Goldilocks story, right? Too much is the dad, his bowl's too hot, too little is the mom, bowl's too cold. We want just right. Okay. So make sure that you are looking for just right. And there's a range in the just right zone. Some people are just a little bit more against risk. They just feel anxiety over it, or they're just not sure what to do if they lost their money. So they would just be like, I can't do that. And they're lower on the risk reward scale. But it can't be too low. If you have it just in a savings account, that's too low. I mean, savings accounts are important, but they're not investments, right? So you need to be in the Goldilocks zone, but you can be on the bottom, or you can be, pushing it a bit higher on the top, but just don't go too high because you're likely to lose all your money. So there's that range there that you're looking for. Another thing to keep in mind, if the opportunity to invest sounds too good to be true, it is. When someone tells you there's no way you can lose on an investment and the returns are north of 6%, be wary. Now, why do I say 6%? Well, there are high yield savings accounts that offer around 5% right now. So, I mean, if someone's like, yeah, put all your money into that high yield savings account, guaranteed 5% return, you can't lose. That's a very terrible sales pitch for an actual thing, right? 5% on a savings account, that's a thing. But if someone's telling you you cannot lose for anything above that, you got to be worried about that, okay? Because anything above that is going to have some risk involved. Even putting all your money into a total market index fund, there's risk involved there. It's not as high as a risk as others, but there's risk. So, but usually you're going to hear like, oh yeah, guaranteed, 20% return. Guaranteed. If they're going to say guaranteed and then they're going to offer you a return on your investment, just be a little worried. All right. You need to understand the risks. They need to be honest about the risks. And if you're being told that this stock is going to go up, you need to put all your money into it. That's putting all your eggs in one basket. That's betting on black. Just be worried about that. You want to make sure you're not putting too much money into one thing, especially if that thing sounds too good to be true. I'm just warning you right now that if it sounds too good to be true, it probably is. Now, uh, just a little caveat, you might say, wait a minute, I've seen, higher than 6% on, savings accounts or on CDs. Okay, that was probably back in the 80s. They had higher rates back then. We haven't seen those rates since, And I hope we don't see them again because the 80s was a tumultuous financial time for us. So those higher rates were indicative of a time of inflation that was much worse than it is today. So just keep in mind that if you're getting those higher safe returns, there's probably something else happening in the economy to balance those off. But for right now, 2024, if you're getting a higher than 6% return, it's not guaranteed. Okay, another thing to consider is time horizon. How long do you plan to hold this investment? For most investments, the longer you hold it, the more money you can make. And often the risk goes down as well, the longer you hold it, right? So think of holding the total stock market index. We've talked about this before, and we'll talk about it again here in a second. But if you have a little bit invested in every company in America, over the long term, America is going to go up, most likely. If America stops going up, you have bigger problems than the money you invested crashing. Okay, like if America just suddenly plummets, then we've got some bigger problems. So you can bet on your value going up over the long term. That doesn't mean that if you want that money next week, it will be there because stocks are volatile. They go up and down pretty sharply sometimes. But over the long term, they tend to go up and to the right. So if you have that long time horizon of 20, 30, 40 years, you can expect that if nothing crazy happens, it's going to be much higher than it is today. So that is the longer time horizon, increases your reward and decreases your risk. It happens with a lot of other investments too. The longer you hold something, the more money it will generally be able to make. I mean, we know this just kind of intuitively. People holding on to like a baseball card, and then 60 years from now, that baseball card is worth a lot more than you paid for it. So there's this idea of things go up in value over time, and so the longer you hold it, the better, generally speaking, in investments. If you are needing money in the short term, then you want to change your investment strategy. Maybe you need something safer but also generating a return. So like a CD is safe. It increases your interest that you get back a little bit. So I mean, you can get in that 5.5, 6% range sometimes on a CD, but then there's the caveat of you can't pull that money out without a penalty prior to this, 6 months, 1 year, 3 years, 5 years that you have it locked up in the bank. So just keeping in mind that if you have that 5-year time horizon, you can put money into a CD and that will increase your interest rate that you can safely have without increasing your risk. And bonds are another similar thing that you can do. You can put money into bonds. We'll talk about those things, but I'm just saying that there are some shorter term options to increase your return on investment that are safer. So you want to consider the time horizon. If I'm having a shorter time horizon, you want those more safe options so they aren't going to plummet in value. And if you have a longer time horizon, then you can do those more volatile options, not riskier, more volatile options, because in the end, you're going to have that higher return on investment with that lower risk later. Once again, assuming that everything has gone the way it's supposed to. Okay, so those are the main things generally to think of when you're looking at investments. Now let's talk about investment types. There are many ways to invest your money, but many of them are not for the average person. Okay, you can invest your money in so many things. Like I already talked about cryptocurrency. It's probably not a good idea to bet it all on Dogecoin, right? The Dogecoin king, right? The guy that made his millions by putting all of his money into Dogecoin lost it all because he had no idea what he was doing. So you need to know what is happening with that investment and not just do it because it's fashionable, right? Investing in fine art. If you are not a fine artist or a connoisseur of fine art, then that's not an investment that you should be focusing on. Putting money in startup ventures. These are inherently risky. They're going to have 1 out of 10 actually work out. So you need to be able to put a lot of money into a lot of them, and then that 10th one is going to explode, and you're going to get your return. But if you just put your last dime into your cousin Billy's startup, you're probably going to lose your shirt. So just keep in mind that you are not going to want to invest in most investment options out there unless you are very specifically trained in that or you have the money to lose if it doesn't work out. So I want to focus instead on the three things that I think most teachers should invest in most of the time. Now, this is a lot of most, and the reason I'm doing that is because your specific situation is probably different, but these are the things that I would like you to consider as the average teacher for your investment portfolio. The first one is bonds. The second one is stocks, and the third one is real estate. So let's look at bonds first. Bonds are not really a long-term investment. They are an inflation-fighting savings tool. What I was just talking about before is they're a way to de-risk your portfolio. They are great if you are getting ready to use your invested money. So this is why. If you are putting your money into bonds, U.S. Treasury bonds, the U.S. government is stable. It is the most stable entity that's been in the world for the last 100 years. And it's known to be safe. People are keep investing in it because it's safe. And because it is safe, it is a lower return on investment. So many people want U.S. Treasury bonds that the yields, the interest rate goes down. So it's just not going to generate the 8% return that we were talking about to help you, reach your $1 million goal. And now that being said, just because they are safe right now doesn't mean they will always be safe. So you don't want to just say, well, U.S. Treasury bonds have been safe for the past 100 years. They're going to be safe forever. Okay, there's not a guarantee in anything, but for now they are considered a pretty safe investment, but they're not going to make you fabulously wealthy. If you're getting close to retirement, they are still an important part of your strategy, though. So moving some of your other invested money into bonds can be a great strategy. Now, I don't necessarily think this is super important to do for teachers because we tend to have a sufficiently large pension and or Social Security that we could live on if times get tough because we have that additional pension that most people don't have. It's usually a livable pension, not a lavishly livable pension, but livable. So if you are retiring and then the next day everything takes a nosedive and you don't want to pull money out while everything took a nosedive, you could live on your pension until values came back up in your stock portfolio or something. But if that seems a little risky for you, because once again, your risk profile depends on how much you want to play the risk, you could, before you're getting ready to retire, 5 years or so beforehand, slowly start moving your stock investments into bonds while it's at its peak in the market. So that way you are getting the highest value for them. And then they're sitting in bonds because bonds can keep that money's value against inflation, but they're also not going to drop in value suddenly. So you want bonds to be able to draw from if the market takes a nosedive right after you retire. If it doesn't, you keep those bonds going, you just keep rotating them into those inflation fighting numbers and draw down from your stock portfolio until that takes a nosedive. Then you have these bonds on the side to protect you in that event. So that's the role of bonds, really. There are a number of different bonds that we're not going to go into, but I mean, you might be like, well, I've heard of a bond that gets 14%. I bonds are what those are called, and those are very volatile in the percentage they get because they're trying to be an exact track of inflation. So if you heard like that high, super high, I think it was 11% actually. That's because that was the projected inflation at the time. It's much lower now, but it's still a good option. Say you are wanting to put money into bonds for your retirement preparation. I bonds are a great way to do that, along with other bonds that they have, U.S. Treasury bonds. But just keep in mind that that is the short-term option, is what bonds are for, is to protect your money against inflation short-term, not to grow your money long-term. The second one then is stocks. Stocks are where most people invest most of their money most of the time. Once again, a lot of mosting going on. That's because most retirement plans invest in stocks for you. If you are using a 401k or a 403b or a 457 or an IRA, chances are you have your money invested in the stock market because they are what people invest in. There's just that it's easy, it's done electronically. You don't have to really own anything that's super like tangible. You don't have to worry about it being stolen, really. I mean, there's fraud out there, but like someone can't like walk up and steal your stock. Okay, that's just different. So it's just an easy thing that people can invest their money in for retirement. So chances are you're already invested in this, whether you even know it or not, which once again is something to be worried about if you don't understand why your money is being invested where it is, especially your 403b. We've talked about this many, many times. I had Dan Otter from 403b Wise on to talk about how investing in 403bs can be quite dangerous because of predatory companies who are going around the lack of regulation to just prey on your retirement. So take a look at your 403b. Make sure it's being invested in worthwhile stocks, things that you agree with, things that you want your money to be in. So make sure you understand what your money is being invested in and the fees and so forth with that. But I digress. There are two ways to invest in stocks yourself if you are the one controlling your stocks. One is to pick individual stocks, and two is to invest in an index. Picking individual stocks is only slightly better than gambling. The reason it's only slightly better is because, generally speaking, the US economy is going up. So you're more likely to win most of the time picking stocks, while gambling, like the chances are against you because that's how the house always wins, So you are just a step above gambling if you're picking individual stocks randomly. If you are picking individual stocks after lots of research, then the potential is, even higher that you aren't going to be gambling with your money. However, that takes a lot of effort, a lot of research, a lot of time, which is not one of our available resources as teachers. So I generally speaking recommend against picking individual stocks because it is time consuming and it just has more risk inherent in it, because even if a stock seems like it is going up today, a company can fold up and disappear tomorrow. Okay. Number two, investing in an index. An index is a large basket of stocks. The most popular ones are the total market index and the S&P 500 index. The way it works is there is, say 1,000 stocks in the total market for the United States. If you buy the total market index for say $100, well, you have $100 going between 1,000 companies. So it'd be like 10 cents of ownership in each of those companies, or however it's probably based on the actual value of each company. But the point is that you have just a little bit, itty bitty tiny minuscule sliver of ownership in each of those companies for each one unit of the index that you're buying, and that grows over time because the whole market is growing over time. So as you buy it, you have that $100 of ownership of the entire US economy. Basically, when the US economy grows, that $100 becomes worth $101, $102, $110, and $140 over time. So when you are ready to pull your money out for retirement, say that $100 is now worth $460, you are able to take one share and have $460 instead of the original 100. And the same thing works for the total or the S&P 500 index. So you can buy indexes of different kinds, but the point is that these indexes are going to have that return across a large group. And the great thing about an index is, let's say I'm buying the S&P 500. There are 500 companies, the biggest companies in America on this index. If I buy that, then companies say, I don't know, I'm thinking of Sherry's right now. Sherry's, the restaurant in the Northwest, is going bankrupt at the moment, unfortunately. I love Sherry's, love their pie shakes. If you haven't had a pie shake from Sherry's, I'm sorry. Think of a pie blended in a milkshake. It's a wonderful thing. But they are going bankrupt. So let's say they were one of the 500 biggest companies. They aren't. But if they were, they are going bankrupt. They would drop off of the list because they are no longer one of the top companies. You then have, a new up and coming company. Say you have a new tech company that's coming up. I can think of there's a company that makes computer chips that is up and coming at the moment. So let's say Sherry's drops off because they are, going bankrupt. This new tech company pops on there. So while your index has the losers fall off, up and coming winners come on, and that lifts the whole index up higher and higher. So the beautiful thing about indexes is the worst thing that can happen to any of the stocks on the index is it goes to 0%. But the upside potential is limitless. Right? We have companies, $2 trillion right now. It's just an absurd amount of money that these companies are worth, and they continue to grow. So just keep in mind that having an index reduces your risk, and your reward will probably not be as high as if you happened to invest all your money into Amazon on the ground level. But the chances of you choosing the next Amazon are low. And if you choose multiple companies to invest individually in, and they all go to zero, so you invested in 10 companies and they all go bankrupt or they all go down, you lose that money. But if you invest in the index, it will likely grow and you will get that money. So the reward goes down, but the risk is, the reward is lower, but the risk is also pretty low. So investing in indexes is generally speaking a well-proven way to invest over the long term. Once again, past performance is not indicative of future results. So, there's no guarantee it will go up. But if the entire market of the US economy is going to the bottom, then where your retirement money is not your biggest problem. So we really shouldn't worry about that right now, because that is an absolute end of the world worst case scenario, and it's just not likely to happen. Okay. Third one is real estate. I think that real estate is the most powerful wealth generating tool for anyone, especially people who don't have lots of cash to put into the stock market. Now, that doesn't mean that you should just run around throwing money into real estate in any way possible. We're going to talk a lot about what it means to invest in real estate in later episodes. But the most important thing to realize is the reason why it's a very powerful wealth generating tool, and the reason why you can get better return than in the stock market, is because it isn't as easy as clicking a button to open a brokerage account and put money into an index. Like, you can literally do what I just said in the next 20 minutes, because it takes some time to, create an account. You cannot do what I just said, with real estate. You can't just, click around and be like, okay, I'm in real estate now. It's just not going to happen. If you decide to get into real estate, it takes a lot of time educating yourself. But this is a relatively simple model. You just need to educate yourself a lot in it, so to make sure you understand the pitfalls. So real estate's not a complex thing. You just want to be educated so you don't lose your money making mistakes. And if you're going to get into real estate, you need to get a mentor who has done what you want to do and follow their advice, because having somebody on hand that you can talk with and work with who can help you through your investing journey in real estate is going to be invaluable for you. So you need to find somebody who would be willing to work with you. That's going to be another thing that you need to do to get into real estate. And you need to make sure you have a significant enough financial cushion that you can weather a storm. Now, this is your emergency fund plus an extra cushion for real estate. So it does take some time to save that money up. So if you are saying, look, I don't have the time for the education, I don't have the time to save up money for my real estate cushion, then maybe just putting money into the stock market is the better option. Your stock market is not going to have as good of a return as real estate will have, just because the only returns on stocks are going to be equity and dividends. There are dividends in a lot of options, and I didn't talk about those. Those are just payback from owning a stock, which is a great way to get money. I'm not saying it isn't, but I'm just saying those are your only options. While real estate has multiple wealth generating levers, such as having leverage on the properties you own, getting cash flow from the properties you own, pay down on loans makes the amount of equity you have go up over time, and then appreciation on the value of your asset, and then tax benefits for owning real estate that you don't get for owning stocks. So there's just a lot of different levers that increase your wealth by owning real estate. But once again, it just takes a lot of education, a lot of help, and a good amount of money to get started. You can't just start with $10 like you can investing in stocks. We'll do an entire episode, like I said, on the different ways you can invest in real estate. And I'm talking about my investing journey, the benefits I've had from investing in real estate, the pitfalls I've had from investing in real estate, and just what I think about it moving forward. So be on the lookout for those. But just realize that whatever path you are choosing for investing, the whole issue is not what investment should I make? Really, it's when should I make it? And the answer is now. The sooner you start, the more likely you are to reach your goal. The compounding effect is huge, right? The only reason why putting $1,000 a month into an investment that has an 8% average return got you to $1 million in 26 years instead of 83 is because of compounding interest. The ability for things to build and grow and compound on itself over time makes the differences between these things rather small compared to the difference between not starting and starting. So the sooner you get started, the sooner the compounding effect can work to your advantage, and the sooner you'll have the money you need to retire. So I invite you to start studying a bit about investing. Be on the lookout for more in investing episodes. You can make a decision and start going on it. And that's what is going to make all the difference. Remember, as an educator, you are already wealthy. Your wallet just needs to catch up. Are you worried you won't have enough money to retire? Or maybe you just don't know how you're going to get out of all of this debt. Whatever your situation is, I can help you. Go to teachermoneyshow.com/guest and fill out the form there. And you can come on the show for free coaching, or we can meet one-on-one to discuss your needs. I look forward to talking to you.